So as we get ready for tomorrow's is the USDA report that comes out, and so let's jump into what that means and how it could be impactful to the market, and then we're going to jump in and talk about weather for just a minute, and always we're going to talk about the charts. All right, so over here, if you haven't seen this spreadsheet before, it, it, the USDA publishes their stuff, and we summarize it over here. These big numbers are the numbers that matter, right? And this is the number that they call the carryout. So, and I want to be clear on the time frame because this was really important for tomorrow's report. This number is what the USDA says we're going to have left over on August 31st of 2021. So these crop years go from September 1 to August 31. So for this report, they're giving us an estimate of that date. So what about where we should be on August 31st of 2020? Well, that number is right here. So this number is in flux. A lot of people think that this number is stagnant, and it is absolutely not. So as we get ready for tomorrow's report, the surprise that might come is that this number can creep higher. So a lot of people think that they're going to talk about yield and acreage and harvested acreage, but they're not going to do that tomorrow. They're not going to adjust acres and yield at this point tomorrow. I don't believe. But what they might do is raise this number higher. And the reason they might do that is twofold. It's first because of export demand, and second, it's because of lost ethanol demand. As you look at the ethanol numbers, the grind has returned and it's improved, but we're still only grinding at about 70% of what we were pre-COVID. So what that means is that there's fewer bushels being used in ethanol production, which means that this number increases. So the average trade estimate for tomorrow is that the USDA increases beginning stocks by 50 million bushels. And that is probably going to be because they lower what they expect to be used in the ethanol grind. If they lower it more than that, that would be a very bearish surprise. So then we want to look at what could come next, right? Because at the end of June we have the big report, which is where the USDA tells us officially how many acres got planted to what, and then we can start to laser in on yield. And we've been hearing a lot of talk about acres being shifted from corn to beans, and nobody knows if that's true or not. So for tomorrow, this is what the market is expecting. They're expecting the carryout to be increased slightly because of lost ethanol production. If they raise this more than what the market's expecting, then that would be viewed as bearish. If they raise it much less, then that could be viewed as bullish. So I don't expect a lot of fireworks tomorrow unless this number is worse than expected. For soybeans, it's the same situation, okay? And I think beans actually have potentially more risk than corn does even, because this beginning stocks number could be adjusted. This is what the trade is expecting. They're expecting the USDA to lower the beginning stocks and hold everything else constant to show us an ending carryout of 425. What could happen is the USDA could come in and say China's well behind where they should be, and instead of and our export pace is just abysmal, and so we need to decrease exports, which would raise this number. If they do that, that would be a bearish surprise and take us lower. Now, on the right and left of each of these, you have different carryouts. So you have different adjustments, right? Where if we shift acres if for some reason we don't plant bean acres, or if for some reason we plant more and you have yield, and you can see the range. So beans have a huge range, right? We can go from extremely tight to extremely burdensome on a carryout. So beans could move very significantly either direction, and that's what we're looking for, is which changes could be the most impactful. If you come back to corn, corn has less impactful moves unless they're bearish. So the downside risk in corn is real, provided that we grow the acres and we grow the crop, right? And we've been talking about this for weeks. But even if you plant fewer acres, hurt the yield, improve the export situation and demand, well beyond what the USDA is saying, even if you do all those things, you still have a burdensome supply situation. So the upside in corn is limited without a extreme weather situation. So let's look at that on the chart. Let's start with December corn. All right, so here is December corn. I drew this circle a couple of weeks ago. For those of you that have not seen it, what this is a circle that we drew, and the right edge over here is July 15th. Or if you've ever seen a seasonality chart, by July 15th, we've corn has historically put in its highs in this time frame, from the end of May through the middle of July. And where we chose the price level at is a 38.2% retracement to 61.8% retracement of the entire move from here. So this is the move from January. If we're to get into this situation right here, then I think that would be a nice area to put on some sales. Unfortunately, yesterday's trade action wasn't very good. So you've got this what we call a doji star right here, where on the candlestick it went higher, came back and closed flat, and then you have follow through to the downside. That was not bullish trade action yesterday at all. And if it continues to break, I've got 339 as the major support level. And if that breaks, then I think corn could really be in significant trouble. So let's talk about what you can do in the corn market. A 330 December put today is 14 cents. You can set your floor right at this price level for very little cost and leave your upside completely open if something were to happen. For guys that don't want to spend a whole lot of time marketing and don't want to overthink it, this isn't a bad option. You can hold your cash. You can set that floor, right? We've been talking about selling a move back up into this green circle. If we don't get there, then we're just going to have to take what we have and take our lumps. So for those of you that I've been working with regularly, you know that the basis levels in Kansas especially have been very strong. In fact, in most areas in Kansas, we've inverted old crop to new crop to a premium of about 30 cents a bushel for June-July delivery versus O&D delivery. And that inversion has causing some support to come into the new crop basis. So we've been taking advantage of that and rewarding that basis rally by locking in some sales, especially for guys that need to deliver bushels and collect cash during this calendar year. The market's giving you that opportunity now because the basis levels are pretty good. Remember, if we have a 3.5 billion bushel corn carryout, basis is not going to be your friend because no one's going to have a reason to bid up for you. So if the market's giving you a good opportunity now, what is the harm in taking it? I just don't see that argument of I'm going to hold my basis because it might get better. If we do continue to rally, so you can sell your basis and set a floor. On a higher rally, you can either move your puts higher or you can sell your cash or a combination of both. And then if for some reason we were to break higher and we were to break this 61.8% retracement level and we were to eclipse this 380, 390 number on December corn, if for some reason that were to happen, then at that time you can always examine the situation and re-own your bushels. You're not taking any risk that you can't manage from that point. So what could potentially propel corn above this 390 level and all the way up to challenge these highs up in 420? Honestly, I think the only thing that could do that is an extreme drought. So if you look at the weather forecast in the 8 to 14 days in the 6 to 10, it is hot and dry. And if those hold and get us all the way through mid-July, then we can put some weather premium on this market. And we've talked about the fund position. They're very short, and most of their short position was built from this level or below. So if we're able to crawl above it, and we didn't get there yesterday, if we're able to crawl above this 352 level, then that can put some pressure on the shorts and that could provide a catalyst. Now, weather will be our guide to whether a rally up into here, if it happens, is short covering or whether there's actually a bullish story. And I would recommend holding buybacks until you decide that there's actually a bullish story and it's not just short covering. In the meantime, I would just sell it again, and sell it again, and sell it again, because a $3.5 billion carryout is not our friend when it comes to basis or flat price. All right, I'm going to get off that soapbox for a minute and switch to new crop soybeans. So we just went through on soybeans a very similar situation, right? Where beans can have an extreme tightness or an extreme oversupply. And we don't know which we're going to deal with yet, which is exactly what this chart is telling us. This cloud area here is neutrality. It's telling us that above it we want to own it and below it we want to sell it, and anything in this middle ground from 870 to 850 is neutral. So as a grower, what we can look at is the cost of defending the bottom range of this price, right? If your thought process is I want to own it and keep my upside above this level, then the real simple thing to do is spend 16 cents, which is very inexpensive, to defend that level. You can even come up to 850 and 860 for I think they were 860s, I think, are 25 cents this morning. So you can come all the way up to 860 and defend that for 25 cents, or 840 for 16, and set it and forget it and not worry about what happens beyond that. If for some reason we're to rally all the way up to this 912 level, really we get above 928, 930 and hold it on a closing basis, then I think you start to look at what the situation is. Are we truly tightening and constricting that balance sheet? Are we getting this weather event that are we getting a La Nina or a weather event that's going to really hurt our yield chances? I think you reevaluate it up to here, and in the meantime, you just sell it. Set your floor, and just continue to move. Part of my caution is it's June 10th, and we've had a hot and dry forecast now for several days, and we haven't done anything with it. So that gives me a lot of pause to think that any rally is going to be pretty short-lived. So we want to be active in reducing that downside risk using the tools that we have available for it. Now let's look at July, because it's still the most active. This green box is a box that we drew several weeks ago. I wish we could say we were good and called the fact that it broke out of the upper corner of it, but that's just pure coincidence. The reality is that it did break out. It broke through all of this resistance, and then yesterday was an important day because it broke all the way down, tested all of this resistance, which is now support, and bounced. So if we have the follow through up above 869, 870, then beans could really accelerate higher and come test this $9 level fairly quickly. What will cause them to do that? I have no idea. I mean, if the USDA trims its export forecast and says that the marketing year for this year is not going to materialize, then this is going to dissolve real quickly, and we're going to come challenge the lower end of this range. I have very little doubt that if that happens, then we're probably going to set new contract lows here. If they hold steady and don't give us a curveball and leave things kind of normal, then this should set up and has a very good chance of moving higher. If you're a speculator, this is a nice defined risk reward, right? You've broken up out of resistance. You've had a nice 2-day sell-off that held support, and now you're turning higher. So a move above 69 to 74 is something that a speculator is going to say, hey, let's add some length here and give it a shot, because we have a defined entry and a defined exit where you can lick your wounds and move back to the sideline. So this is an interesting setup, and absent the report, we'd be very bullish. With the report, we're pretty hesitant to say what it may or may not do. In wheat, wheat's just in the exact same spot it was last Wednesday when we started, when we had this conversation, and we said then that anything below 470 and above 440 is neutral, and we still have that exact reading. Nothing's changed in the wheat market. We do have this little upward lift or upward tilt, but as long as we're below this cloud and we're sitting below this 470 level, I think the downside is very real, because the way that this is counting, you can see these green or the blue and red numbers. The way this is counting is that this can extend to a 13, which would be lower and would put this low in jeopardy, and very likely this low as well if it were to move in. So if we get harvest pressure and we and yield starts to surprise some people, then we could see lower trade in Kansas City wheat pretty easily, especially if corn breaks as well. If we start to work higher, that's fantastic. Maybe we'll have some bullish surprises in wheat. This is telling you that's 50-50, and we'll just have to wait and see what the price action does to tell us what we need to be hearing and looking for. All right, that is 18 minutes. That's all I've got for you today, and I hope it challenged you a little bit, gave you some ideas on what to do with marketing. If you have questions, please call me, and we will talk through it. Have a great day.